Is this going to be another 2008 where banks just start falling like dominoes, with Silvergate Bank and Silicon Valley Bank both failing within a couple of weeks of each other? One of the things that's interesting is, and I was around in the 2008, 2009 financial crisis. I was hot and heavy in real estate. That was at probably after when I exited my first company at 30 million. I had 30, $40 million worth of construction loans in process when banks started failing and calling loans and all that stuff was going down. So I was right there in the thick of it. I was not in stocks yet. I made my first big move in stocks at the bottom of 2009. And it wasn't because I knew the bottom or whatever. I had a friend who worked on Wall Street and retired, and he called me up and said, "Hey, this is going to be a generational opportunity." So we got together every morning, started following the markets and trading, but that's another story. Right now, we're going to take a look at the charts because there are some similarities in terms of the time of the year that the banks started failing back in 2008 before the fallout and the big collapse of financial markets, banks, and everything. So let's go ahead and jump in and take a look at the charts and see what was happening. So this is the market from the bottom. I drew a little trend line here from the bottom. This is S&P from the bottom of 2009 all the way up to connecting the bottom of the pandemic, kind of creating a trend line and where we are in the market now with this bear market downtrend. And the question is the market going to continue, the S&P, to follow this downtrend? It could pop up above the line, it could go underneath and just kind of follow this trend line down, to a base at some point, to about 3,000. And there are some people that are calling, for the S&P to hit that 3,000 range with hiking interest rates and the move that the Fed's making. But what's interesting is if you take a look at the price action, so right here was March of 2008. That's when Bear Stearns failed, which was the first big bank. That ultimately ended up in a rescue situation. But then following in September, which was about right here, was when Lehman Brothers failed. And Lehman Brothers was not rescued. It was allowed to fail. And that was the catalyst that really triggered the big sell-off in the markets and, more banks and systemic risk and all that, creating the big financial crisis that ultimately bottomed in March of 2009. So basically a year after the first bank failed, the market finally bottomed a year later. And that was with, bailouts from the government, bailing out companies, bailing out banks. We had the whole TARP, Toxic Asset Repurchase Program, where the banks were buying all of the where the federal government was buying all the toxic assets from the bank. And what caused all this, obviously, was mortgage, bad loans, bad mortgages that were packaged into derivatives. And this was a multi-trillion-dollar systemic risk event where major banks, all the big banks, Citibank, Bank of America, JP Morgan, Goldman Sachs. I mean, everybody was at risk and had exposure to the mortgage market because of all of the exotic loans and subprime loans and things like that were, repackaged, rehypothecated, and all the derivatives that were created from those products and levered into the system. It was trillions and trillions of dollars. And, back then the financial system was probably, 15, 20 trillion, somewhere around there, maybe 10, 20 trillion. Whereas now, the banking system is about $30 trillion, 25, 30 trillion, somewhere around there. So with, this price action here. So again, this was when Bear Stearns failed in 2008. If you fast forward to today, I mean, here's where we are right here. So if you look at this kind of rollover, this is a little bit sharper of a decline. Obviously, this was more of a rollover till it got into this area. And then it really started, tailing off right in this area here, a little bit more sharper, kind of like what we're seeing right now. So it's just interesting. It's the same time of year, but it's a very different situation. So Silvergate Bank, Silicon Valley Bank, probably combined, $200-300 billion or $500 billion, whatever it is, the banking system is, $20-30 trillion. So you're talking about a 1% event isolated to those banks because of, poor risk management, poor interest rate risk management, poor investment, management that they were doing and risk taking, did not have enough cash reserves and things like that. But what's really interesting, what triggered the bank run for Silicon Valley Bank was obviously a tweet. People tweeting, Peter Thiel tweeting, telling people to get their money out of the bank, and then it just spread like wildfire. So now in the digital age, which we didn't really have back here in 2008 and 9, There were bank runs back then. Wells Fargo, a couple other banks were having runs back then, but it was contained. And banks, obviously Lehman Brothers, Bear Stearns, there were some issues there, but those were somewhat contained, and it didn't really go viral as quickly as it does now. So, the real question is, what do you do now? Number one, you need to make sure your bank is FDIC insured, so that your deposits up to $250,000 right now will be insured and guaranteed by the government. So if you're not in an FDIC insured bank, you probably need to go ahead and move that money into that. If you have balances above that, then you need to spread that risk out into multiple accounts in different entities. Because again, if you're one entity in your name or your business and you have multiple accounts under that business, that's only going to count up to $250,000. So you really need to study what that insurance is all about, what the limits are, how it works. You need to have accounts in different banks if you have more money than that. And then the other ways to mitigate that risk is with treasuries. Obviously, you could buy stocks. There's risk in stocks. Treasuries are pretty much risk-free. You can go to Treasury Direct and buy treasuries direct from the government. You can get them through your brokerage account, through your banks, things like that. But basically, this is not a systemic system where these two small banks are going to. Well, I mean, they're relatively larger banks, but they're not huge. Are going to take out anything in the system or the economy and create a domino effect like it did back in 2008 and 9. Again, that was a multi-trillion-dollar event with the housing market collapsing. Right now there are some risks, and I'm going to make on the next video we're going to talk about what are the systemic risks out there with banks right now that could potentially cause a problem. It's not Silvergate and the venture capital community, but there are some risks out there that could eventually put some pressure on the banks and create some problems throughout the financial system, and trigger, some things. So we'll talk about that in the next video tomorrow. We'll take a look at some other, charts and things like that. I know everybody likes to take a look at Bitcoin, so let's do that real quick before I wind this up. So this is kind of the trend I'm watching on the S&P, and then Bitcoin, of course, is just kind of hanging out during all this because, a lot of people would say, well, if the banks are failing and people are worried, why not just buy Bitcoin? That can be a play for some people, and we'll talk about that more. This is on the weekly, Bitcoin on the weekly right now. We're going to look at the 200-week moving average, still well below that. But when you go over to the daily, Bitcoin did find support on the 200-day moving average, which is a key technical level for most market participants, especially in the traditional finance world that is playing in the crypto market. A lot of technicals are set on that 200-day. If you're above the 200-day, you're generally bullish. If you're below the 200-day, then you're generally bearish. And I did the same thing with Bitcoin. I drew the trend from the bottom of the 2018, 2019, connected that to the pandemic bottom and extended that trend line out. And then the question is, will Bitcoin continue? Let's go ahead and take it off of that, bring it up here. Will Bitcoin continue to follow, this trend line, work its way down ultimately to this area here, which depending on how long that takes, the price could be variable. But, a couple of things to think about with Bitcoin in general is, how low can Bitcoin go? Well, we don't know. It's all going to depend on the financial system and conditions overall of the markets and, traditional finance, what's happening, things like that. But one thing to think about that's really interesting is a lot of people have called for the bottom. Even me, I'm not calling for the bottom, but I think, there's a good probability that the low has been put in at that 15.7 range, not up here. A lot of people called the bottom right here. A lot of people were calling the bottom here, but this was a lot of people calling the bottom here at 17.18. This potentially could be, but a couple of things to think about. One, we're still in a bear market. We're still in a rising rate environment. We're still in a recessionary concern environment. Number two, if you think about just how Bitcoin functions, and a lot of people talk about, saying that where the bottom is in because of all the historical indicators and just different things. And again, price indicators follow price. They're all lagging indicators. There are no indicators that are going to tell you the future. They all track price action. So if price jumps, indicators jump. If prices drop, indicators drop. Moving averages, everything. So any kind of custom indicator, any kind of whatever, all you can do is look at a 10-year, 11-year history of Bitcoin or 12 years, whatever it is, since 2009. Because it was born out of the great financial crisis, because banks were failing, peer-to-peer exchange of value. So you can bank yourself, trustless system, which is why it was created for times like the other day. But anyways, those indicators, those averages, they're all just historical and they're going to follow price action. So they're going to look how they're going to look. And if things change, then the indicators change. But anyways, Bitcoin always draws down about 80 to 85% in bear markets, and up to 90, initially in 2011. We'll look at that in a minute. But 80% puts Bitcoin at 13,000, somewhere in that range, right? 83% puts Bitcoin at 11. 85% puts Bitcoin at 9,500. So historically, Bitcoin has always drawn down those levels. That was, current prices we're looking at. Let's look at 2020, 2018, 2019. That was an 83% drawdown. Let's look at 2014, 2015. And I'm going from closing. If you go to the wicks, it's, much more significant. Again, 83%. If you take the wicks and you draw down, then you're looking at, 86%. So let's look at 2011. 2011. And that was a big wick right there, but that was a 95% drawdown from, this big wick here. And then closing basis, probably not as bad, 88%. So you're still looking at probably 83 to 85% average. So the people that are calling right now for the bottom, based on historical, behavioral patterns of Bitcoin, indicators, all those types of things, the one thing that still hasn't occurred that's always occurred is an 83 to 88% drawdown in Bitcoin. So again, where is 83%? I'm not saying this is going to happen. Let's just go from the wick, or will happen or is guaranteed. So from the wick of the peak high, 80%, again, is 13, 83% is 11, and 85%, is about $10,000. And there's a lot of technical, indicators that would show that, a $10,000 to $13,000 Bitcoin is probably highly likely. There's a big probable chance that it could do that, which is back to about this level here, right in these areas here. So, that is a potential, but there's also a potential that, this level here, 15.7, could hold up. But again, if we get into a situation where the economy really starts cracking, financial markets really start to sell off, and we have recession concerns, other banks start failing, and we get into those types of situations, Bitcoin's going to sell off just like other risk assets, and it's going to drop just like it did back in the pandemic, and just like it did in 2018, 2019, just like it did in 2014, just like it did in 2011. So those were all kind of in concert with, financial market sell-offs and things like that. So that's a quick update there. I will make another video. In the next video, we're going to talk about what do you do from a cash management standpoint. And like I said, in the meantime, make sure your bank is FDIC insured. If you have accounts above $250,000, you need to spread that out over multiple banks, multiple entities within a bank that has multiple accounts, things like that. And then, of course, you can buy treasuries. That's probably, we'll talk about where and how to manage your cash and how to manage your company treasury in the next video, because you have options between stocks, Bitcoin, treasuries, real estate, things like that. So we'll talk about all that on the next video. But in the meantime, make sure your bank is FDIC insured and spread that cash out in the meantime in multiple accounts. If you've got too much money, then just buy treasuries. So I will see you on the next video.